Okay, so that's nice. We can make a cash budget. It's a good thing to know how to do. All you got to do is practice, and it becomes a lot more straightforward. So we can project cash flow, and this is a good thing. And we will be projecting cash flow a lot in this class. But really, what we're trying to do now is figure out how to manage cash flow, right? Because if you can measure it, you can manage it. And so we need to do some, background working capital analysis background to talk about how you can manage it. Um, but the thing is that's important is that the role of a financial manager is to make sure that you are producing the right amount of cash coming in to take care of what you need to pay going out, right? So understanding what the cash is that's flowing in is super, super important. So, um, the background, sort of theoretical background here, is this idea of a cash conversion cycle. The difference between when you purchase the raw materials that you're going to use to make your products, and when you get paid for those, that's called the operating cycle. And then you can reduce your cash conversion cycle by managing your payables. Right, so there's three different sort of sub-cycles, they call them, in your textbook. And by the way, the textbook uses vocabulary that is not necessarily the only words that you'll see describing these ideas. Okay, so I try to give you synonyms here so that you're familiar not only with these production cycle, collection cycle, payment cycle, but also the other words that are used broadly in the world of finance to describe these concepts. So the production cycle is the time it takes you from when you purchase your raw materials, then you build your product, and then you sell it. That's your production cycle. And if you think about like the balance sheet accounts, you've got raw materials inventory, then you've got work in progress inventory, and then you've got finished goods inventory. Right? So that's the production cycle, the time that your goods are sitting in inventory and haven't been sold yet. And then the collection cycle is the length of time between when you make a sale and when you actually collect from customers. And that's what we just calculated. Okay, we just did the foundational work to understand the cash collection cycle. Okay. And then the payment cycle is the amount of time that you take to pay your own bills. So if you're building, a lectern, like I keep talking about in class, if you're building that wooden stand that I stand behind when I'm lecturing, that's called a lectern, and you buy the wood, how long does it take you to pay for the wood? Okay, that's the payment cycle. All right, so vocabulary, here it is. Now, as I said, the cash conversion cycle is basically the operating cycle minus the payment cycle. The operating cycle is the production cycle plus the collection cycle. Right? So these are just simple mathematic relationships. Just get your head around them. And the cash conversion cycle begins with the production cycle. It begins when a customer places an order, and it ends when the product is shipped out. And then the collection cycle begins when an order is filled, and it ends when payment is received. And the payment cycle begins when you hire labor or you purchase raw materials and ends when you pay for those production costs. Typically, firms have to pay for production costs before they receive payments from customers. So if you think of, I think of a farm every day, right? I'm living on one. A farmer buys a seed long before they sell any vegetables. Or, a manufacturer of wooden lecterns buys the wood long before they sell them and receive any cash, right? So all that time between when you purchase the goods, the raw materials, and get the money for the goods that you sell, your cash is not with you. You're sitting there, somebody else has your money. right? You don't have cash. And so you have to keep track of these cycles so that you can have enough cash to do what you need to do. Right, so how do we keep track of these cycles? All right, let's try number 1 in the practice demo. Okay, so here's our setup. We have Stewart and Company with a production cycle of 40 days, a collection cycle of 20 days, and a payment cycle of 15 days. Okay, there it is. So remember, the operating cycle is the production cycle and collection cycle. That's the time it takes between buying your raw materials and getting cash from a sale. So the operating cycle is 60 days, I can see. Okay, the cash conversion cycle then, you take the operating cycle and subtract out the payment cycle. That's going to be 45. Easy peasy, right? And then they ask you this interesting question. They say, if we want this number, if we want the cash conversion cycle to 35 days, what do we need to do to get there? Right, so, you can think it through, or, you can just try it and see. So the top one says it decreased the production cycle by 10, decrease the collection cycle by 10, increase payment cycle by 10, or some combination. So what happens if we decrease the production cycle? Okay, that works. So that's our answer. Okay, so now we're actually going to calculate these cycles. Okay, so there's 3 steps. We're going to look at a production cycle first. Okay. First, you got to figure out what your average inventory is. And then you calculate a financial ratio, which is called inventory turn or inventory turnover. And what this tells you is how many times in a year you churn through your inventory that's sitting in your warehouse. And then to get to your production cycle, which is also called inventory turn days, you divide 365 by the inventory turn, and that tells you how many days sales you have in inventory. Now, I am going to copy all this stuff over. The next several questions use this setup. Right, so what we're going to do is we're going to do some preliminary calculations. We're going to do some preliminary calculations first. Okay, the first thing to notice is that these are balance sheet accounts on top. These are accounts that show up in your balance sheet. They are the value of various assets and liabilities. These are the value of your working capital accounts, actually. And then these are income statement accounts. Okay, that's the first thing to notice. So we're going to work with both the beginning and ending balance sheets and the income statements. Okay. So the first thing that we're going to have to do is calculate the average inventory. And I can tell you right now that we're going to have to calculate the average value of all 3 of these. So let's just do that all at once, right? So let's calculate the average. And we can either add these 2 and divide by 2, or we can invoke the average function, which you would have seen in the beginning Excel work that I had you do. All right, so it's just the 2. Don't be taking the average of all 3 columns. Okay, there we go. Okay, and now, right, we just remember that formula. Our production cycle is made up of inventory turn, right? So first, there's 2 steps to calculating the production cycle. First, you calculate inventory turn, which is cost of goods sold over the average inventory. All right, so there's our cost of goods sold there. Average inventory of 57. Okay, what that tells us is that we run through our inventory 10 times a year. Okay, what does that mean? If we're running through our inventory 10 times a year, that means that every 30-something days, right, we run through it. If it's 10 times a year, then what you do is you divide 365, the number of days in the year, by 10 to get how many days sales you have in inventory. So we call this our production cycle. Just 365 divided by turn. Right, so our inventory turns over every 36 days. Okay, the next cycle that we need to evaluate is our collection cycle, which you basically do the same process. You figure out your average accounts receivable, and then your accounts receivable turn is credit sales divided by the average accounts receivable, and then the collection cycle, as before, is 365 divided by the AR turn. Okay, so let's go ahead back over to Excel and do that. Okay, so our collection cycle. First, we calculate our accounts receivable turn, which is the credit sales divided by the average accounts receivable. Okay, so that's easy enough to do. Here is our average accounts receivable. Here's our credit sales. Okay, so our AR turn is 16. That means that we clear our AR, our accounts receivable, 16 times in a year. So then our collection cycle is 365 over the turn. All right, so 365 divided by that 16. So our customers, on average, pay us within 22.81 days. So this next question is another collection cycle problem. Okay, and the question is, if you had a total sale of $970,000, how much of it would have needed to be cash in order for the company to meet the collection goal? So first thing, you got to scroll through the top, right? Because for me personally, I did not see this collection goal the first time I sat down to do it, right? So we want to get this down to 20 days. All right, so the key to this, super, super important, all right? You need to set up the inputs. Okay, remember I said that when you have assumptions, you want to have the assumptions separate from your calculations? Right, so these are some assumptions. And the assumptions are that your total sales are going to remain at 970, but you can change the combination of credit and cash sales. And the way that you do that is you set it up so that credit sales are equal to total sales minus the cash sales. So if I, instead of having that be a number, if I make this a calculation, it's total sales minus cash sales. It's going to give me the same number, right? So that's that 672. But now it's a calculation. And so now, right, everything flows from the cash sales. If I change the amount of the cash sales, if I say it's 350,000 cash, watch what happens. This credit sales number is going to change, and all of this down here is going to change. See that? Okay, everything flows from the cash sales. And so we have this way in Excel of basically never doing algebra. If you set up your formulas right and you set up your assumptions right, you can use this cool thing called goal seek. Okay, now goal seek is found in the data tab up here. And you go data, and then what if analysis, and find goal seek. And the inputs that it's asking you to give it, right? We want our customers, we want this collection cycle to be 20 days. So I want to set this cell here where the collection cycle is, I want to set that cell to be equal to the value of 20 days by changing the amount of cash sales. And what'll happen when I hit OK, if you look closely, you'll see Excel like run through. It iterates until it converges on the answer. See that? So now we have the answer. The other thing I want to note, MyLab assumes that you are using algebra to figure this out. The answer that actually calculates in MyLab is 203,500. The reason that there's a small difference is rounding errors. Excel uses all the data and it brings numbers out to, 1,000 decimal points. So these kind of rounding errors will come up sometimes, and sometimes you'll be marked wrong in MyLab, even though you've done it right. When that happens, trust your guts. You know how to do this. Trust that you've done it right, and just email me and say, my answer was this, 203,506, and it's marking me wrong. And then when I go all the way through, just don't stress about it. Just tell me what the situation is, and I'll make the adjustment in your grade. Okay. But this one, I think it will mark it right, because what happens is MyLab has like a tolerance, it's called. Yeah, so it does mark it right. But if it happens that you get dinged for a rounding error, don't worry about it. Okay, the last piece of our cash conversion cycle is the payment cycle, and it's exactly the same. It is, first you figure out the average accounts payable, and then you calculate your accounts payable turn as the cost of goods sold divided by the average accounts payable, and then you figure out your AP turn days as 365 divided by the AP turn. So let's go ahead and quickly run through that, and then I'll stop the video after that. Okay, to calculate the payment cycle, you first hit the AP turn, which is the cost of goods sold divided by the average AP, accounts payable. So let's go grab that. Our cost of goods sold is 570. We divide that by the average accounts payable of 26. So that means we clear our accounts payable 21.92 times per year. And let's see, and our payment cycle is going to be 365 divided by the turn. So our payment cycle is 16.64. But that's not what they're asking. Once again, they're asking you to do algebra. Except we're not going to do algebra. We're gonna use Excel. So we set a target of 15 days. Right? So you notice that I went through the process of setting up the equation. Because what we want to do is the same thing that we did before. We want to do goal seek to get this to be equal to 15 days. So you have to have the equation set up, even though that's not what they're asking. Now this one, they said, what would be the ending balance in accounts payable have needed to be in order to have it be 15 days? Okay, and that's an interesting question. Now, why do they say, what does the ending balance need to be? Well, because presumably at some point we were in the year of 2014 and we should have been managing this better. We should have said to ourselves, oh, geez, our payment cycle is a little bit slower than we want to be. We want it to be 15 days. The financial management aspect of this is through the process of looking at the value in this balance sheet at all times. Every day you can get a balance sheet. Certainly every month you can get a balance sheet. And, you can say, oh, geez, I know if I want this to be 15, I know that this number has to be something different than 27. Let's figure out what that is. Right? So again, we use our goal seek. And we say, I want this number here to be equal to 15. By changing this time, we're changing our ending accounts payable. That becomes our target. So this needs to be 21,849 in order to be able to get our payment cycle down to 15 days. So that's it. That's what you need to know from a math and analytics standpoint from Chapter 13. Now, the management side of it is a whole different thing, right? What can you actually physically do to pay your bills faster? What can you physically actually do to get people to pay you faster? What can you actually do to make your production cycle shorter? Right? Because it's all about cash management. And so you're going to have a consulting assignment where you're going to be doing analysis of this sort. This is the sort of the beginning of the analysis of working capital that you're going to be turning into actual advising of what people can physically do. You get to work, you look at some numbers, you manage to the numbers that you want them to be, and you do actual physical management of actual people and processes. Okay? So that's it for Chapter 13. We will continue on with some additional material in the next video.